What is up, everybody? Happy Monday. Welcome back to Benzinga Live, the first episode of a new era for this show. Thank you to everyone who is going to stick with us through this transitional time. As you can see on the screen, it still says Spencer and Aaron. I am holding out hope as if I were a kid whose parents told them that their dog just went to the farm, that someday that dog will return. But for right now, you guys are stuck with me, and the show will go on. Today, we have a busy day. Classic Monday, Benzinga Live. We've got Matt Hammond joining us here in about 5 minutes. We're going to talk some IPOs with him. Then we've got Jake Wujastyk from TrendSpider coming on at 1. And then at 1:30, we will have Cruz from TD Ameritrade, Schwab, joining us, talking about what they're seeing over there, kind of what Sean is looking at. So good lineup for guests today. We will also be talking topics-wise. We'll do another touch on gas prices and oil and energy stocks. We had solar running today, so we'll talk about that. We will talk about the Amazon stock split, of course. Is now the time to get into Amazon after the stock split? We will discuss. I have thoughts on that. We will discuss the latest in the Twitter Elon Musk fiasco, the deal that everyone seems to not be able to stop talking about. There's always new developments in there. So Elon, Twitter, more news there. We will get to that. And then as always, if you guys have any tickers, any stocks, any trades you want to check out, just go ahead and throw them in the chat while you're there. Smash the like. It's Monday. Let's go ahead and get the show started. I'm going to play the intro. Keep in mind, this intro has not been updated yet. So if you hear Spencer in there, just don't miss him too much. Don't miss him more than I do. That would be hard to do. But yeah, let's go ahead and get started.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher. So.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wujastyk from TrendSpider. We have a breaking news.
All right, guys. So let's start the show like we do on a lot of Mondays. We're going to bring Matt Hammond on from IPO Warriors. If you guys are new here, Matt has had a pretty crazy last few months. Matt was living in Ukraine, in Kiev, the capital, and has since fled to Portugal. And actually, over the weekend, Matt had some pretty exciting personal news. So I'll let him share that from his own mouth if he wishes to. If not, then it's all good. But let's go ahead, give Matt our special intro, and bring him on the show. Matt, Mr. Hammond, how you doing today?
Hey, how's it going, Aaron?
Good. Can you hear me and everything? I know we were having some connection issues before the show.
Yeah, I can hear you. It just pauses every once in a while, and I guess it's still streaming when I see that. So I'll just power through that and keep talking. If I see you freeze up, I'll assume that you're still there and keep going. But yeah, had some big news. It was actually last week on the 31st. My daughter was born, and you're right. We actually fled Ukraine 2 days before the war started, while my wife was about 5 months pregnant. So on top of everything else that goes into being, I guess, a refugee in Europe, we were doing all this while we were pregnant. And on top of that, we kind of were forced to move to, into Europe right as the big holiday season was approaching. Europe takes its holidays June, July, August. So during that time, people don't really want to rent their apartments for a long time. They can make like triple, what they would on an annual monthly basis. They can make 3 times that just renting in, say, like June, July, August. So no one really wants to rent to us, but we were able to find a place just this last week. So on top of having a baby, being a refugee, we're also moving apartments like now. So yeah, not a lot of time to focus on trading. But one of the things I love about the IPO trade is that it's really kind of a 1 to 2 day trade, and you can kind of trade them when you have time to trade them. There are typically a couple IPOs each week. When the market's really kind of hurting, we see less of them. Last year, we had a record number of IPOs. This year, we have much fewer, but they're still coming, and there's still a lot of win opportunities. The trades that I'm generally looking for on these is I'm not getting early access to these. I'm not getting special treatment. I'm not getting the IPO at the IPO price. I'm generally buying on the debut, or there are a few other variations where I'm looking for a dip to recovery. But the trade, the kind of the most straightforward trade that I'm looking for is buying the IPO or buying the stock when it debuts trading. It doesn't start trading at 9:30 on the day of the IPO. There's a process where they balance the number of shares from people who got IPO allocations against people who say they want to buy them on the debut. And I've laid all of this out in a trading guide. If you go to ipowarriors.com, sign up for the newsletter, you get the IPO trading guide that really talks about the strategy. It's worked phenomenally for me. I mean, I've changed my personal financial situation just by trading the IPOs. And you can't just trade every single one. There's certain things we look for. There's different kind of classifications of IPOs in terms of how I approach them. And I talk about all that in the free guide. I talk about that in my newsletter each week. Each week I recap the IPOs from the week before and talk about and then send out a new newsletter, usually on Tuesday, breaking down the IPOs that are coming up for the week and what I'm looking for to trade those, which is similar to what we do on this show. So yeah, let's jump in. And can you share my
I can, here? Mr. Hammond. Let's go ahead and do it. And yeah, we've talked about before just how kind of trading and work in general can sometimes be that healthy distraction from everything else going on in the world. So
for sure, life can distract you, and certainly many times where life is more important than this. But just like I'm a big Warriors fan. My team's in the finals right now, so even if it's 1 a.m. Tip off here in Europe, sports are great. Distraction. Music can be a good distraction, and trading stocks can be a great distraction. But I would say that when you're trading, you want to be aware of your mental state and really think about how much risk you're willing to take while you're in perhaps a less focused state of mind. But there have definitely been times over the last few months where seeing an opportunity or just watching, I'm almost just more casually watching stocks. And then when I see an opportunity, I really ask myself, do you think this is a good opportunity? Or are you just bored in trading? And if I'm bored in trading, that's okay. I can just take a tiny little position just to be involved. And even that can be a nice distraction, but it's really taken a lot of pressure off my trading. I've been able to effectively trade these IPOs very well. And we've had some really big runners and other ones where you just have to say, I can't really touch these, which is just as important a discipline to have. The only time I really burned myself badly with an IPO trade was last December, and I had a lot of stress going on in my life at that time, and really probably shouldn't even been trading. I had not slept well for a couple days, broke all my rules, traded kind of aggressively and angrily. It wasn't a good setup. So pay attention to your own sort of mental state when you're trading. But yeah, trading can be a great distraction when there's when you're trying to kind of overwhelmed with some of the other realities of life. But let's jump into the IPOs this week. First, I want to review last week's because, like I said, it's really important to understand what setups are not going to, are not worth trying to trade or trying to force yourself into. And we have two good examples of last week. One was a setup that was kind of the setup that I really like, but then turned out not to be a good debut. And I'm going to explain that a little bit once we get into this. And I'm going to go back to the Kenny Rogers hit that we all know, which is know when to walk away, know when to run. You got to know when to hold them, when to fold them, when to walk away, know when to run. It's very important with these because especially once you start kind of stringing together a bunch of wins on trading these IPOs, you start wanting to trade each one. I mean, last year when they were it was like win after win after win after win. I just couldn't wait for the next IPO to come. Then the market started getting a little more sour. And actually before that, the market started getting so hot that the IPOs were debuting at ridiculous highs that couldn't be sustained. And you just need to know, a big piece of this is picking, separating the losers from the winners and playing the winners with conviction, playing the losers, not at all, or looking for reversals. So this one of the things that I've talked about and we've pointed out many times is these Chinese IPOs, or what I often call stealth IPOs. They really don't make a lot of sense. They don't even promote them very much, which is one of the reasons I call them stealth IPOs. My theory is that there is some kind of money laundering system going on here where we're talking about IPOs that usually have a float lower than 5 million shares. In contrast, a mainstream IPO is usually going to be about 30 to 50 million shares. These are the companies that you've heard of. Bausch and Lomb, I think it was 35 million shares. That was the most recent mainstream IPO. We haven't had a lot of mainstream IPOs this year, but somewhere in the 30 to 50 million share float is typical of an IPO for a company that you've heard of, a mainstream company. Low float IPOs, I consider anything less than 5 million shares, and these low float IPOs are most of what we're seeing right now in the market. Like the institutional bankers that support, that anchor the mainstream IPOs just aren't interested in putting their money into basically growth stocks right now. Most IPOs are growth stocks. So what we're left to play are low float IPOs, which are great too, because they have a lot of volatility. We've seen quite a few that have debuted even at pretty high premiums. We had, it was JCSE, we had OST. Both of these were priced at $4 or $5. They debuted at around 15 and ran up to like 25 or 30. AUST was another that priced at 3. It debuted, I think, 6 or 7, ran up over 20, and then dropped back down. So there's these are trades you can make in one day, and in some cases double your money, or take relatively straightforward 40%, 50% wins in an hour of trading. So one of the setups that I look for in these low float, kind of lesser quality IPOs, there's a couple things I look for. One, for the stealth IPO, we're looking for generally a float less than 5 million shares. We're looking at pricing typically is like $4 or $5 priced per share. There's certain underwriters that we're looking for. We're looking for Bosted Financial or Bosted Securities. We're looking at Network One Financial. Sometimes it's Aegeus Capital. Sometimes it's Prime Number Capital. These are kind of the names that, usual suspects. And then ties to China. They're not always directly obvious. This one was so obvious that it was almost, I was pretty sure that this was going to debut at a price that made it untouchable. So in this case, Zhongyang Financial priced at $5 and it debuted at $27.50. $27.50 is just too much. It's just too high for me. I usually look at about 17 as the point at which it doesn't give much upside. I might be tempted to go a little bit higher than that. But when we see these debut, we've seen these debut at 43, 40, 35. I just walk away from it at that point. The only time I really burned myself was kind of forgetting that, buying in at $27.50, and it actually halted up and then opened below that, significantly below that. It's the halt of death, as I will refer to it. But this one, once I saw it debut at $27.50, this one went live. I wasn't really in a position to do more than watch this one. If it had indicated an open at around 13 or 14, I could have gotten in and played it for like a halt or two. But at $27.50, just walk away from it. It was a stealth IPO, an IPO that prices at $4 and then opens at $27.50, or price at $5 and opens at $27.50. The only explanation that I can make for that is that people are basically intentionally trying to lose money, even for it to trade where it's been trading in the traded over at $20 for most of the first day.
Where does the if you go back to the previous slide where it says
we're looking at it right now, but yeah,
the magic bounce number was like 13. Is that just based off like fib retracements? Where are you getting that number from?
It's just having watched the whole lot, watching many of these stealth IPOs that open way high or do an initial run, like bounce up and come and sell off. There seems to be something about the 13 level. And no, I'm not doing fibs. I don't have anything other than having watched and most of this has been in the last year where we've seen them debut, sell down, and bounce. But if you go back and you look, I think TNON, made a similar move, and a few of the others where, for some reason, right around 13 has been, and this one went down. 13 as in if you'd set a limit order at 13, it could have gotten filled on the way down here and then bounced back up. It's really difficult to trade these without using limit orders because this isn't, this halts straight down. It was a split second. There's no time to even get out with the stop loss. It goes live if you already had your limit order in. And the way to get in on these on the debut is to have your limit order, already submitted before the stock goes live. We can see in certain apps like Webull, TD Ameritrade, a few others will show you what the indication price is before it starts trading. So in this case, it started trading at around 11. I think it was about 11. Started around 10 o'clock. Yeah. So they started pricing this one at 9:50 Eastern time. And they have to do at least 10 minutes. And most of these low float IPOs after 10 minutes will go live almost immediately. Some of them will go a little bit longer, whereas mainstream IPOs can go all day. I rember we've seen mainstream IPOs start pricing at say 10:30 or 11 and not go live until 1:30 or 2. You just be sitting there all day watching the indication price move around a little bit, adjusting your order, and and then all of a sudden it goes live. These tend to price for about 10 minutes and then they go live, and often the first move is just an instant halt. In this case, it was an instant halt down. Other times we've seen instant halts go the other way. And you're not going to have a lot of time to trade other than with limit orders. And then once it's halted, if it's going down and you're already in, you're not in a very good position. If you think, okay, well, now maybe you've watched one halt, two halt. Now you say, okay, well, now I think we've halted enough down. We're due for a reversal. You can put your limit order anywhere below where you think it will open. And some apps do show us this as well. Trade Zero, Interactive Brokers, it does seem like those give pretty accurate opening, the opening out of the halt. So at that point, if you had said, okay, well, I'm ready to take the risk on it, I'll put a limit order in at 13 or 13.05, because sometimes they really bounce right off those hard numbers. Then you get that fill, and then in the next minute, it halted back up the other way. So you can't really sit there and think, or place market orders or stop losses or anything like that. You got to kind of like work with limit orders and try to anticipate where it's going out of the halt. And that wasn't like a super comfortable trade anyway. It still reversed back down before, coming back up through another halt, back up to. So this trade is not the trade that I really look for. This one basically would have been something that after I saw that the indication price was up here at 27.50, I wasn't all that interested. But it did have all of the ingredients that we look for in a stealth IPO. It wasn't very well promoted. It's had a clear China. The tie to China on this one was just too obvious. Usually we have to dig into the S1 filings, look at the CEO, the CFO, the lawyer. Is there a secondary underwriter? These types of things. But
I agree. This one's kind of a pass for me, but let's keep it clipping because we do have
we don't have
another
much
guest
to cover.
coming at 12:45.
Okay.
So we got about 12 minutes left. Just letting you know in case I don't know how much we have to get to, but
we only have one IPO for this week, so
okay.
We'll go through this next one, which is Saver One. This one was not a good looking IPO from the start. First of all, we'd covered it probably for maybe 4 weeks on the 4 Mondays in a row because it kept getting rescheduled. And the reason it kept getting rescheduled was nobody wanted to buy it. And when they can't fill orders, they have to try to move to the next week, hope for better market conditions, maybe change the terms, give some more warrants, bring the price down a little bit, and from there you can't really expect debut to go very well when you see it rescheduled that many times, unless they fundamentally do something like switch the underwriter to an underwriter who's going to support it better or withhold volume. We did see AUST get rescheduled almost infinitely until it finally went live, and the opening trades were such low volume that got pinched up into a pretty massive run. This one did not look good going into it, and it looked even worse once we saw the indication, at 350 after pricing at 413. So it did have warrants involved, and so we can expect it to price below, or to debut below price. But it's already, when you see a sell side imbalance opening below the IPO price, that's not a good. It's definitely not something you want to buy the opening print on. And on this one, I just didn't see anything enticing about trying to play the initial bounce. We've just seen too many of these fall out. There is a play where you can look for these to rally into day two or try to pick off a bottom. You can look at, say, RSI. We never really got well below RSI 30, but if we do see a hard drop below RSI 30, and then once it recovers back up, that's a time where I've accumulated before. Kind of 220, 230. I call it the dental zone. Sorry for the dad joke, but it's time to see the dentist at 230.
That's a good one.
So 230 and below, that's kind of a magical point on day one to accumulate for, what can be either a run into the end of the day, or as we saw with this one, there were some bounces. Today was the second day of trading. So you saw in pre-market, it rallied up to 294. So if you're on, say, Webull, this one was at 645. There was a little bit of a spike on the open to 260. You're not talking about big gains. We have seen some of these run on day two or even day three. So, there are plays there. I don't have much conviction in this one. I don't really like the setup on this one very much at all. It's also an uplisting from the Tel Aviv Stock Exchange. So not an IPO that I would put on my, I wasn't excited about this one. There are IPOs that I'm more excited about. And that brings us to this week. So given what I just showed you, but the two that I illustrated, I want to see who can determine what type of IPO I would classify this one as. And I think it will be pretty obvious. So on the surface,
So we've only got 2.5 million shares. Seems pretty low float.
There you go. So we got the low float IPO. That's one tick on the checkbox. Phoenix Motor Group, based out of Southern California. So we think maybe it's not a stealth IPO at first. Well, this is a California-based EV company focused on electric drivetrains. Their products are basically Ford F-450s that have been converted to an electric drivetrain. One of the other things I look for in a stealth IPO is really, really bad financials. So this is revenue down 55% for the 9 months ending in September 31st, 2021, and gross profit down 56%. Over the time period, and negative 9% gross margins, negative operating profit, negative income, negative cash flow, and all of these metrics are actually widening instead of contracting. So when you look at financials like that, you're like, what kind of shape is this company in to even be going public in the first place? And then you see that they dump their original book runners, who were Maxim Roth and E.F. Hutton, and they've gone to prime number capital. At that point, I start going, okay, prime number capital, they've done a bunch of like stealth IPO type setups. And, maybe this is worth looking into, because the last one that kind of switched underwriters was, I think it was OST, went with Bosted, which is a usual suspect for stealth IPOs, and that one turned out to be a really, really nice play. So the next thing I'm going to look at is, okay, well, can I find any ties to China here? Well, we've got a chairman whose name is Dentun Pang, and we've got a CEO whose name is Dr. Lance Zhao. All right, so that's kind of, who's the CFO? Chris Wang. Okay, so we definitely have some, we have an executive board that's.
But wait, does the company itself have any like actual business ties to China, or does it just happen to have some Asian executives?
Well, first of all, it's not just that they're Asian, in my opinion. It's that they're the CFO, the financial brains behind it, Tony Zhao. So these are no, the company itself does not have direct ties to China. But if we go to the Phoenix Motors S1, so now in the S1, I'm going to see. Well, can I find something here that maybe ties them to to China? Is there maybe a law firm?
I don't know anything about this company, but to me, just the fact that some of the executives are Asian or have Asian names does not mean enough to me to say, okay, this company has exposure to China, so I don't want to be interested in it.
Yeah. I missed a few IPOs that turned out to be stealth IPOs, and the hints that I was able to go back and find were generally that I found, often just the CFO with with the Chinese connection. So is that enough? Is it just obvious? No, it's not. But when I combine that with them switching to prime number capital after leaving, the others, and it's let's see, no here. I found in another listing the active S1 that they are also engaged with. The law firm and the lawyer has a Chinese name as well. So for me, that they've switched to prime number capital, that it's 2.5 million shares, that the revenue is terrible. I mean, what business does this company have to go public with these kind of numbers? These are, it's enough to make it interesting for me. And the last thing that I've done to kind of get a sense of where this might be going is to get this is available. I think it's available right now on Webull for pre-order, as was OST. And, I'll put in a pre-order for, say, 100 shares and see what kind of fill I get. If I get 100 shares, that's not a great sign, but okay, $800 or whatever. If I get 10 shares, well, now I know that they're not, given much to retail. And I just want to show you guys what OST did on day one to kind of illustrate this a little bit better. So OST, don't even really remember what this company does. It doesn't really matter. If it's a stealth IPO, it's going to get ripped. And if it's not, well, now you're just playing an EV name. Okay. OST priced at 4, opened at 10.10, and just went up into halt, open at 16, halt again, open at 20, down into a halt, reverse back up, topped out at 28.59. End of the day, it ran to 43.97. And this was such an obvious stealth IPO. I had, we were live streaming it. A bunch of people got into it. Everyone who traded it on the debut made money. And where you really killed it is if you somehow held into early pre-market. Not a lot of volume there. I guess you couldn't make that much. But if you sold it up here in the in the early trading of normal market hours, 42, 43, in at 10, out at 40. But I also want to show you this. You do not want to hold on to these. Like, take your profits, be happy, take profits, no regret. That's rule 1. Rule number 2 is don't chase. If you miss the debut, I really don't recommend trying to chase in, at these prices. There's just too much downside here. But I like, or I would say it's definitely on watch. And the last kind of piece for me on trading these as a stealth IPO setup is, okay, this is supposed to price at $7 to $9. If it, if the IPO price, let's say it prices at $8 a share. Now, what I'm going to be looking for is in that pre-debut indication, which I've talked about earlier, does this offer, is this showing that they are constraining the volume? So I'm going to be looking for volume. If the volume is like around 100,000 shares or less being traded on the open, that's a good sign. If there's a debut premium, so they're debuting it, there's enough demand to open it at like $15, $16. That's a great entry point to me. And is there a buy side imbalance? If I see a sell side imbalance, if the debut has no premium, if they're opening at $6, then I was wrong, just completely wrong. If they show a debut premium of like $40, well, then I was right, but I can't trade that. So I'm looking for a very specific setup on the indication. I don't think I'll be able to live trade this. I wish I could, to live stream this. Sorry. Just got too much going on this week. If I can, I'll tweet it out. But I definitely will, with 2.5 million shares, you have to expect volatility on this one way or another. It's already getting buzz on Twitter. So I like this for an opening trade, but it really comes down to a game time decision based on the indication price and whether it's stealth or whether it's just a low float IPO will, determine everything about the opening movement. I do believe that we'll see, unless it just debuts at a ridiculous price, I do think we'll get an upside halt simply because day traders are kind of keen on these again. EV, although it may not be as hot as it was before, Chinese EV plays, this week have been a little bit hotter, or, in the last week have been a little bit in focus. So I like this for at least a halt up on the open, and definitely will be actively watching this to trade on the debut.
And then, Matt, I know we've talked about it a lot on the show, but
that's what I got, Aaron.
Awesome. I know we talked about it a lot on the show, but we just got a question in the chat asking what exactly is a stealth IPO.
Well, I think I'm still talking, and Aaron is frozen on mine. Oh, there he goes.
Uh-oh. All right.
There you go. Okay.
Thank you, Matt. Can you hear me now?
I can't hear you now, yeah.
Okay. I was just saying we had one question in the chat asking exactly what stealth IPO is. I know we've talked about a lot on the show, but I just wanted to give you an opportunity to.
So stealth IPO, as I understand them, or why kind of me and a few other traders started kind of using that term to describe these, is that they don't make a lot of sense in terms of how they are marketed before the IPO. A lot of IPOs are highly promoted. They're on all the calendars. And the first ones that I really noticed that ripped like this were some stocks like WNW, which opened at, I think, $7 and within a week was up at $160, and now it's under $1. TIRX was another one. EJH was another one. And there were these kind of like string of Chinese IPOs that came to market with no real announcement. They weren't even on the calendars. They weren't in the newsletters. They were kind of like sneaking onto the market, and they were all pricing, under $10 and just going on these massive runs that made no sense. I mean, how did these stocks that were, really sketchy sounding companies, I mean, EJH literally was like a maid service, and it, as I recall, opened somewhere around 8 or 10 and ran up over 30, and now it's back down to $1, less than $1. And, I started kind of catching these, and I caught a bunch of them, made a fortune on some of them. And the only thing that I could make sense out of them is people are trying to lose money. And why would you try to lose money? I mean, why would you buy a $4 IPO for $30 or $40? Why would you do that? Unless you're really trying to move money from your account to somebody else's account. And, I started talking to more people. I started talking to some of the people who know the underwriters, or actually the underwriters themselves. And of course, no one's going to openly admit it, but people, when I started sharing my hypothesis, they weren't telling me I was wrong. So one way, and they've caught people, groups of doing this before. I mean, how can you launder money through the stock market? It's not that difficult. You get a stock that nobody else is trading, like an IPO, because it's not even on the market yet. If I had, say, $200 million that I wanted to move out of my Chinese account into a Western account, I would take those shares and give them to, a close friend or a family member, give those shares to somebody who had a Western bank account. And then all I have to do now is, buy those shares from them at a ridiculous price that nobody else wants to pay. Well, how can I do that? Got it. You set up a low float IPO, you drive the price up to a price that nobody else, in their right mind would pay. And then you just buy them, so basically if I'm the only one buying it and my friend has all the shares, I'm basically moving my money to their account. They're giving me these shares, which we both know are not worth anything. And then when those shares are just, tank, that's okay. It doesn't really matter. I've now moved my money into that person. Nobody else got in the way. Nobody else was trying to buy those shares at those prices. Maybe a few people, but I mean, even if I lose 20% of what I'm moving, like laundering money, is both expensive and illegal. But doing it this way, there's not a lot of, there's not really a trail. I just said, well, I thought that this stock was worth $40 a share. This like unknown dry cleaning company in China.
All right. Well,
I think it's worth
that
$40 a share. So I have the right to pay
that
for the shares. So that's why we call them stealth IPOs. They're trying to go unnoticed. They've delivered, they trade at ridiculous prices, and we keep seeing them coming. Sometimes they're not directly tied to Chinese companies, but once after the fact, I go back and look at them. SOPA was a great example. Like all of the executives were Chinese. SOPA was another one, priced at 9, ran to like 60, I don't remember, 50 something, 70 on day 2. And then
all right, I think that goes ahead and answers the question of just what is a stealth IPO. Matt, thank you for coming on. Look forward to chatting with you next Monday.
Someone else asked, I did not get a haircut. I just combed my hair a little bit. I need a haircut. I haven't gotten one since I left Ukraine, but next week.
All right, Matt,
hopefully.
We'll talk soon. All right, guys, that was Matt Hammond from IPO Warriors. I'll go ahead and drop that link in the chat if you want to go ahead and check out the site, sign up for Matt's newsletter. If you're interested in IPOs, it's one of the best resources out there for IPOs. Thank you, Josh. Appreciate it in the chat. Everyone that is out there in the chat, please go ahead and smash the like as we keep the show ticking. I'm going to bring on my good friend Zahir Anwari. He's one of my favorite contributors we have at Benzinga. Zahir is a technical analysis trader. He knows charts very well. He is based in Europe, so he's got kind of an interesting outlook where he's looking at European equities as well as U.S. stocks, Forex, you name it. Zahir is your guy. So whenever he gives me, the thumbs up that he's ready to come on, we'll go ahead and bring Zahir on, see what's been on top of mind for him. Let me see. Oh, Zahir is ready. All right, let's go ahead and give him our special intro, bring Zahir on, and then after Zahir, we'll have Jake Wujastyk from TrendSpider. We still got to get to Amazon. We still got to get to Elon Musk new Twitter news. We got to get to Bitcoin. Bitcoin having a nice day. Is the bottom in for crypto? Should we be looking at Coinbase right now and some other crypto stocks? We will talk about that. But first, let's go ahead and bring Zahir on the show. Zahir Anwari. Zahir, how you doing today?
I'm very good, thank you. How you doing?
I'm doing well. How was your weekend?
Yeah, I had a great weekend, thank you. It was a long weekend, actually. Thursday, Friday were bank holidays because of the Queen's Jubilee. I'm not sure if you guys were aware of that.
I've been seeing stuff on Twitter and in the news about the royal family, about the Queen, but I'll be honest with you, Zahir, I don't really keep up with the royal family that much.
Well, yeah, apart from what's happening with Prince Andrew, probably. But yeah, exactly. It is what it is. We got 2 days off. I was in Portugal for a week before that, came back, and it was bank holiday. So we got an extra 2 days off and then the weekend, and back to normal today.
Beautiful. I love it. So I'm curious just what's been kind of on top of mind for you, Zahir, recently, what you've been watching. Have you been watching Forex markets, bond markets, stocks? Let me know.
Well, I mean, I generally keep an eye out across the board. That's where my weekend analysis comes in. So I start with the stock market. That's my sort of bread and butter. But I then also look at foreign exchange. I look at commodities. I look at cryptos as well. Bitcoin, you mentioned earlier. So I think we're at a very interesting time in the markets because we could potentially be seeing support. The S&P 500, there was quite a reversal at the end of May, an indecision candle for the monthly time frame at the 4,000 round number on the S&P 500. Bitcoin seems to be finding support. The dollar index seems to be reversing. It's actually found a bit of resistance. So, across the board, the the markets are at interesting levels. If these levels hold strong, then we could see, trends resume, which is ultimately what we're waiting for.
Yeah, and you can go ahead and share your screen. I don't know if you have any charts that you've been looking at. Otherwise,
yeah, absolutely. Yeah, just give me a second.
yeah, take your time. Otherwise, I was going to say we can just go through, whatever the biggest stocks you've been watching, some interesting things.
Yep. So, okay, here we go. So if you can let me know if you can see my screen.
Yes, sir, we can. Let me go ahead and get that up. All right, so we're looking at the S&P 500 here.
Yeah, absolutely. So this is the 3-screen setup that I have used on previous sessions with yourself. So I have the monthly time frame in the top left corner. I have the weekly time frame in the top right corner, and I have the daily time frame across the bottom here. The monthly is where I have major levels of support and resistance. So you can see all of these lines across the bottom. These are all major levels of support and resistance. And then I've got the green line at the top here, which is the high of the previous calendar year and the low of the previous calendar year. So typically what I'm looking for is an asset to be trading above the high of last year for it to have a bull market, or the low of last year for it to be in a bear market. If you look at the S&P 500, it's actually trading between the high and the low of last year. So for me, that's very much a sort of sideways market. If I go to the weekly time frame, I have moving averages. I've got the black line, which is the 200 moving average, and the orange line, which is the 50 simple moving average. Again, typically, I want to see price trading above the averages. At the moment, you can see price trading between the averages, which again, it's not really giving price a sort of clear direction. If it's trading above the averages, if I just go back, we can see here from November 2020 up until the high of January of this year, you can see there was a nice clean bull run that the S&P 500 was in, the stock market in general was in. After every move, after every sort of trend in the market, there tends to be a correction, and that's what we're seeing at the moment. Now, how deep this correction can go on for is the unknown. There tends to be a lot of panic. Okay, the markets are dropping, but what's important is to always look for areas where the market could find support and then reverse back to the upside. So at the moment, what you can see is that the 4,000 round number is acting as an area of support, and that's where we're seeing. If I come down to the daily time frame, that's where we're seeing this bounce that we've seen in recent days. But we don't want to get too excited too quickly, because we've seen these sort of bull reversals throughout this year. We had this here in February. We had it again in March. We now having it again in sort of end of May into June. But does that mean the market? Sorry, go ahead.
Is there a specific level or metric that you want to see before you would say, okay, this bounce isn't just a temporary bounce in a bigger bear market trend. Now we're seeing a reversal and we're getting bullish. Have we already passed that? I'm curious where you stand kind of on the more macro standpoint.
Yeah, really good question. Really, really good question. For me, the answer is the 200 simple moving average. So which is the black line. So at the moment, what you can see is that the daily time frame is trading below the 200 simple moving average. But if we go to the weekly time frame, it's trading above the 200 moving average. So we don't have alignment. What I'm looking for is alignment. And for me, that's when the daily is copying the weekly. So if the weekly is above the 200 moving average, I want to see the daily above the 200 moving average as well. Just to give people a little bit of history on the 200 simple moving average, we're very lucky in today's day and age that we've got software that does all the work for us. Go back, before the internet, before technology, old school traders had to draw charts by hand. So they were very particular about the information that they put on their charts. The 200 simple moving average was a proven indicator of the long-term trend. It was one of the main indicators that they would have on their charts. If price was above the 200 moving average, they would go long. Below the 200 moving average, they would go short. And institutions still use that logic today. And if you're into investing and following long-term trends, then that's what I recommend. Use the 200.
Yeah, and I mean, I'm not a huge chartist, technical analysis person. I think I know enough to be dangerous, but just for anyone out there who's maybe new to looking at charts and looking at metrics, when we're talking about a 200-day moving average, essentially what that is the average price of a stock. So if we're talking about the S&P 500, the average price of the S&P 500 throughout the last 200 trading days. So in the most kind of rudimentary, simple explanation is that if you're trading above that average, that's showing that people are out there more willing to buy the stock than what's been typical over the last 200 days, that there's positive sentiment, that it's trending higher above its previous 200 days moving average, and vice versa. If it's trading below it, that's showing, hey, look, people are selling this more than over the last 200 days. The sentiment is more negative than over the last 200 days, which, we talk about trends all the time, and we talk about the trend being your friend. So simply put, even if you're not a pro at looking at charts or looking at moving averages or different indicators, that's a very simple one that you can look at and see and say, oh, okay, this thing is trading well above its 200-day moving average. That means it's got a lot of positive sentiment around it. And again, or vice versa, it's trading well below it. There's a lot of negative sentiment. So that's one of those key ones that if you're just starting out in technical analysis, I think a 200-day moving average, or, people have different, some people like to have the 220-day or the 50-day, and, they have different combos of moving averages they like. But I think the 200 is a great place to start.
Yep, spot on. Just looking at my daily time frame here, I've got the 200, which is the black line, the 50 simple moving average, which is the orange line, and the 20 simple moving average, which is the blue line. And if we just go back to when there were trends in the markets, you can see how the 20 and the 50 act as a sort of a support zone, where if there was a pullback, it kept on bouncing off it, and then eventually, when it does break through the moving averages, that's when you can sort of determine the end of a trend. So yeah, well put, Aaron. Spot on.
Appreciate it. All right, so here, do we have, let's maybe go through one or two more charts that you've been looking at. And then unfortunately we do got a hop today, but we can do another session as soon as you'd like.
Yeah, absolutely. Just to give people just an idea of some of the stocks on my list. So the indices ultimately are an average. The S&P 500 is an average of 500 stocks. The NASDAQ, 100 stocks. The Dow Jones, 30 stocks. So logic should prevail if the indices are an average, there will be stocks that are doing better than the average. And if you've got a scanning and analysis process that allows you to find stocks that are performing better than the average, then you will get better than average results. So some stocks that I recommend people keep an eye out on are COP. I put an article, I've just sent over an article to you guys, which hopefully will go live at some point today. And I'm actually covering these stocks in more detail. So one of the stocks is COP. As you can see, it's at creating new all-time highs. These stocks have all moved over 50% in the time that the S&P has actually dropped 14%. So a really good example of looking for stocks that are performing better than the average. Next is Cbx Chevron Corporation. Again, you can see it's performed really, really well. We've also got EOG, which is now only just breaking out and printing new highs. And MPC, Marathon Petroleum Corporation. Again, this is doing wonderfully well. It's over $100 now. And then finally, Valero Energy Corporation. I hope I'm saying that correctly. Again, you can see printing out.
I think Valero, but you got it.
Yeah, Valero Corporation. Thank you. So yeah, those are the 5 stocks that I've written about in my article today, and I hope it will go live either today or tomorrow. Usually.
Yeah. Well, yeah, we did unfortunately lose an editor last week, so the stories might be going out a little bit. Well, no, we're doing all right. So we'll
of course you are. I mean, you guys are brilliant at the back end. These articles tend to go live pretty quickly, so.
Well, appreciate it. All right, so here we got to get you back on again soon. I love, your analysis. I love talking to you about what's going on in the different markets. I love the accent, everything about it. So anytime you're free, I know it's, guys, smash the like for Zahir because it's already 5 p.m. your time. He's coming on late.
5 past 6.
5 past 6. Wow.
Yeah.
All right, Zahir. Well, enjoy the rest of your afternoon.
Guys. You too. Have a lovely day. Cheers. Bye-bye.
Cheers. I love that. Zahir, guys, and you guys can check out his articles. All you have to do is Google Zahir Anwari, Benzinga, and his author profile will pop up, and you'll be able to see some cool articles of some different analysis that he's done. Again, always a pleasure to get Zahir on. We're going to be doing, we'll probably be getting Zahir on more if he'll allow it, now that Spencer's, has stepped away. So, all right, guys. Going to bring on Jake Wujastyk here in a couple minutes. We'll be doing some more charts, but just before we do that, I do want to just run through kind of real quick the top points from this Amazon stock split, kind of what to look for if you've been watching Amazon stock. If you're thinking, okay, is now my time to get in with the split? Maybe you don't even know what a stock split is or what it means. So let's go through that real quick. I've got an article pulled up from Adam Eckert, one of our great staff writers. So essentially, stock splits, which we've seen a few of them recently, is when a stock price just gets pretty high and the company says, hey, let's do a stock split. Let's bring the price down. It can be a 5-to-1 split. It can be an 8-to-1, which is what I believe Tesla did. Amazon did a 20-to-1 split, as did Google. Google announced a 20-for-1 split as well, but it just hasn't taken effect yet. So say a stock is $100 and there's 100 shares out there and they want to do a 2-for-1 stock split. Now that stock is $50 a share, and instead of 100 shares out there, there's 200. So it doesn't change anything in terms of the market cap valuation of the company. All it is doing, all the stock split is doing, is making that share price more affordable. And there have been some investors, namely Warren Buffett, who has kind of spoken out against stock splits, basically saying like, oh, we're not going to do that. It's not, it doesn't do anything for the company. It doesn't provide any value. I agree there that it's just factual. It doesn't actually change anything about the company. It doesn't change anything about the valuation. What I would say is, I think from a psychological level, especially when you're talking about retail investors, being able to, for me to go out and purchase, say, 10 shares of Amazon today for $1,200 or whatever, I'm more incentivized to do that than to buy $1,200 worth of Amazon stock when it was at $2,500 and I would have to buy half a share. So even though it doesn't change anything with the company, it doesn't change anything, I do think in general, the stock splits are not a bad idea for really expensive stocks. If you want people to be able to go out and buy 10 shares of Amazon, like I said, I'm more incentivized to do that than to buy half a share. So the split was announced on May 27th. The split actually happened, I guess, at the end of Friday's trading session. So today was the first day where Amazon opened up at the new split. Historically, at least in recent history, a lot of stocks kind of in Amazon's category, Apple, Tesla, have fared pretty well after stock splits. Now, you also have to consider these were in different times, right? In 2016 or 2017 or whenever Apple's last stock split was, the markets were hot. Tesla did a stock split in 2020 when we were still in the crazy COVID markets, and Tesla ended up going up over 100% within the next year. This is not that environment. I don't think, just because Amazon stock has split, this thing is going to run because of the split. With that said, Amazon stock is already trading down well off of its recent highs. Let me do a quick little math check here. So from its highs, from Amazon's highs back in November, which now with the split is $184 a share, we are still down more than 32%. And keep in mind that's with Amazon's stock up about 20% from the end of May, or May 25th to now. So even though we're not in that same environment of when Apple did its last stock split, when Tesla did its last stock split, I don't mind Amazon at all right here as an investment. I just don't think, I think stock split or no stock split, it is going to do what it was going to do. Again, basically the really only big difference here with the stock split now is that it will become a little bit more affordable, actually a lot bit more affordable, 20-to-1 for retail investors. So let me know in the chat. Let me know if you're, on my side where you'd be more, say you had $1,000 to spend. You had $1,000 cash in an envelope that you had to invest in Amazon. Or no, sorry, you had to invest in the stock market anywhere. Would you be more incentivized to spend that $1,000 on Amazon now that you could buy 5 shares of it or 6 shares of it or whatever it is at $130 a share, as opposed to, buying one half of a share of Amazon or less than half of a share when it was $2,500. Put a 1 in the chat if you think it does make a difference for you, that stock split. Put a 2 in the chat if no, it doesn't make a difference. I can buy fractional shares anyway. The percentage gains are the same, so it doesn't really make a difference. Because I think both. I think you can make a valid argument on both sides. All right. Let's go ahead. And yeah, Andy, I agree. There's a reason most companies do it, but there's also a reason someone like Warren Buffett says, no, we're never doing a stock split. It doesn't do anything for the company. So that's what I'm saying. I think there's a valid argument on both sides. And we could talk more about Amazon after our next guest, but let's go ahead and give our next guest, Jake Wujastyk, our very special intro. Bring him on, run through some charts. Mr. Wujastyk, how you doing today?
Hey, doing well. How are you?
I'm doing okay. It's kind of sad here without Spencer. Very lonely. I was joking earlier. You can see on the screen it still says Spencer and Aaron. I'm holding out hope like a kid whose parents just told him that their dog is going to the farm, you know. And I'm still thinking maybe that dog will be running home someday.
Well, we'll definitely miss him, and I wish him luck in his whatever he does next. So, but I'm also confident you'll be able to take the reins and be able to continue the legacy. So,
that's the goal, man. That is the goal.
Love it. Yeah, kind of a weird day in the markets, but that's not really too out of the ordinary. The last 6 days, we pretty much just traded in the same range that we've been trading in, at least for the S&P 500, the Qs. A lot of these names are just kind of doing a lot of nothing. So yeah, just another day where options premiums are being burned, and people are trying to figure out if there's any type of direction coming. I mean, we did have a pretty big move to the upside in late May, so maybe this is just some consolidation before the next move up. But at the end of the day, the VWAPs are really coming into play, both on the S&P 500, the Qs, IWM. All of these areas are really a function of previous support zones that are now acting as resistance, as well as these volume weighted average prices. So I'll go through S&P 500 Spy Etf real quick. The main thing on the S&P 500 that's different than the Qs and IWM is the fact that we are above the COVID low VWAP. So the COVID low VWAP is essentially where we bounced off of over the last month or so in the low 3,800s, and then we did get all the way down to right around 3,800 on May 20th. But the S&P 500, the main area that you're going to want to get above is this March 29th high VWAP. So that is right around 420, 421. But if you go to the weekly chart, you'll also see that we do have this previous area of support that is now acting as resistance. So you kind of have an SR flip on the other direction. A lot of the time we talk about, previous support becomes resistance, or previous resistance becomes support. This is in the team of previous support becoming resistance. And you can see last week we really had trouble getting above that red area, and now once again we're having trouble getting above the zone. So this is a really crucial area. We need to close on the weekly chart above. I'm just gonna say 422, because until then we're still in a very kind of gray area. But your main level here for March, the week of March 28th, the high was on the 29th, is right in that same area. So you have kind of a mix of different participants looking at these areas as resistance. You've got horizontal level traders and market participants looking at this area as resistance. You've got VWAP traders who are using the anchored VWAP looking at this area as resistance. So you've got a lot of people looking at this 420 area as an important area. 420 has kind of become a meme number over the last couple of years. So all in all, it's just a really crucial level to get above, right at that 420 area. Now,
I like to think there's some like institutional traders out there that have bids out there at like 420, 69, just because they think they're being funny.
Yeah, exactly. So, who knows what happens from here, but we had a pretty strong move to the upside, and now we're pulling back. So that's not incredibly healthy price action, but at the same time, we are consolidating in this general range. Now on the daily, you can see here the same thing. We don't even really need to use the March 29th VWAP here, because your main level that you want to get above is that COVID VWAP. So this blue line is pretty much the volume weighted average price when we capitulated back in 2020. And this is still a very relevant level. It was relevant back in February, and then again in March and April, where we initially bounced off of this area. So, this, when I say area, I mean, margin of error of 1 or 2%. We missed it by maybe $3 or $4 back in February. We then retested it and missed it by, let's say, about 50 cents in mid-March. And then we moved down and kind of consolidated around it for about a week and a half back in April before breaking down through it. So, on top of that, we've had this previous support zone that's held really well. You've got this area that's really had multiple times where we've tested this zone. I'd say 7 or 8. So the fact that we are breaking back above that area and holding it is worth noting on the bull side of things. But on the bear side of things, nothing's really changing until we get above this previous support zone, which is literally right in line with that VWAP. And notice here, the VWAP from the code low is actually declining now. So that's also something worth noting. People look at moving averages and the slopes of moving averages and flattening out, starting to reverse. This is actually happening in the VWAP as well. So that's worth noting too. So pretty much on the Qs, anywhere from about 318 up to around 322 is your area that nothing's really going to change until we get above that area. And then, on the just basic trend zone support, you really want to see this area hold from around 298 up to around 303. But let's just call it 300 because that's your psychological level as well. So a lot of overhead resistance that we're seeing here. People are playing intraday. This is literally a day trader's market. If you're trying to swing trade this, it's almost impossible. And it may not even be worth, the efforts of trying to figure out what's going on until there's some type of direction, some type of trend that's back in place. But for now, we're just slowly grinding lower, consolidating, and not really making any headway. So I wish there was some more exciting news. Maybe we start trending, but the way that you can see if we're going to start trending again is just looking at basic moving averages. Moving averages are great just to get an idea of what is the trend doing. Are we moving up? Are we moving down? You'll see here that the 200-day and the 50-day are both declining right now. That is signifying that the trend is starting to roll over. You can see here, the famous death cross when the 50 crosses below the 200. That happened way back in March, and it was actually a pretty good signal that we are, maybe in for new lows, and that's exactly what happened. So if you are trying to get an idea when is the trend going to change, just turn on the moving averages, the 50, the 200. Those are going to give you a pretty good idea of, are we starting to move back to the upside on the medium to longer term side of things?
Yeah, no, I mean, I couldn't agree more. We are at a crucial level here. I'm trying to see if we've got any tickers flying in the chat. Okay, so you've got the Russell pulled up.
Yeah, I mean, look at this. I mean, literally to the cent almost. Previous support back in February, both times tested in February. Same thing as the Qs. We kind of retested that in late April, hit new lows, and now we're really just right at that area. So 188, 189 is pretty crucial here and has been for some time. If for some reason we get some bids and some momentum to the upside, you still have this long-term downward sloping trend line right around 195 up to around 197. So there's a lot of overhead resistance, a lot of overhead supply. If you want to use the volume by price to get an idea of where there are some supply zones as well, if you want to anchor that volume by price, essentially measuring where has volume occurred since the all-time highs, you'll see that it's also right in line with that 195 all the way up to around 200. So just a lot of overhead supply. Anytime the price is below these volume nodes, these gray boxes are just showing how much volume has occurred at this price since in this case all-time highs. There's a lot of people holding at an unrealized loss right now, which is shown by these shares holding up around 200. So once the price gets back up to around 200, which is not only a psychological level, but it's also where a lot of people are holding, you're going to run into what I like to call break-even supply. Some people call it overhead supply. For me, break-even supply just makes more sense because those people who are back to break-even after holding at a loss are likely going to take some off the table or take their full position off the table, therefore adding to supply on the market.
Yeah. I'm seeing a good question in the chat from SWW is asking, do you take into account seasonality at all? Or are you basically just looking at the charts, don't care what month it is, don't care what day it is?
I'm generally very interested in seasonality, but this type of market really throws seasonality out the window. This is kind of like an outlier, right? So this is that time where, April had a 95% win rate or whatever it was for SPY and we closed red. So seasonality is definitely not holding as much weight. So for example, here, if we go to the S&P 500, we go to SPY and we go to the seasonality widget here, you'll see just how strong, April was. Or since I like to measure seasonality since the last really big event in the market, which technically was the COVID low, but there's only been a year and a half, 2 years since that happened. So you don't have many data points on the monthly time frame to look at. So I like to go back to pretty much when we bottomed during the financial crisis in 2009, and you'll see here this is just a widget on TrendSpider. The seasonality widget, and these percentages are essentially just a function of the previous month's close. So in this case, for April, we had an 86% win rate over the last 13 years. So going into April, it was like, whoa, this is a really strong time of year. And then this type of market is something that will destroy those types of statistics, and that will be kind of your outlier, that 14% where we didn't have a strong April. So going into July, technically speaking, it's a very strong time of the year. 85% of the time, July closes higher than June's monthly close. But we are also in this just weird market where we don't have the Fed to just say, okay, we're gonna pull back on talking about interest rates. I mean, look at gas prices. We're still just getting absolutely annihilated. That is going to continue to raise inflation. And the only way that they can do that is essentially have to create a recession in order to kill demand enough where prices are going to drop. And we're just at that point where inflation has become out of control. We haven't had inflation out of control like we have in decades. So we are at a point where the Fed isn't going to continue the status quo of pulling back on, oh yeah, we're gonna loosen up on what we were talking about earlier. They're actually probably gonna have to do more. The only way that oil is going to drop is raising rates, because oil is denominated in US dollars. So as you raise rates, that makes the US dollar stronger. That makes oil even more expensive to countries that have to exchange their currency for US dollars to buy oil. So there's definitely a negative correlation there. Oil, the dollar weakens, oil goes up. The dollar strengthens, oil goes down. And that's technically how it's supposed to work. But even recently, that hasn't worked as it should in theory. So we're just at a point where the Fed is not likely going to lay off the gas at all on interest rates and trying to get this under control. And that's the problem. That's where these seasonal statistics sometimes go out the window when you've got this type of monetary policy has to be enacted.
And then I do want to just give a opportunity for the chat to throw out any tickers out there to see if maybe they want to have you look at something real quick. So then, or one stock that I've been looking at, Jake, which I'd be curious to kind of see your technical analysis of, is SCCO, Southern Copper. So I listened to a great podcast where they were talking about copper and essentially how important copper will continue to be over the next 10 years as we develop more EVs, clean energy type stuff. And essentially just that basically my takeaway from this was that, like, oh wow, copper's being very much overlooked right now. And this chart, it was just interesting to me that it came all the way down from like 78 to 50, kind of. That was in line when the market was turning down, but has since had some nice action. But we're kind of at this point right now where it looks like we could be either running into some resistance, or okay, I'll see what
So
you do.
yeah, I mean, you've got pretty much. I'm on the weekly just to kind of get a little bit of a clearer view here. You got a pretty big broadening formation here. I'd call it a broadening wedge because resistance is downward sloping instead of upward sloping. But I personally, we're kind of in no man's land here. We're in the middle of this massive range of resistance and support. So like for me, I would just throw an anchored VWAP from this high here, and you can see that we are above that VWAP from early April, which is good. Just in general, if you measure the volume by price, pretty much since the start of this trend, and you can pretty much say this is the volume profile of this broadening wedge. If you just start it where the start of the wedge is, you can see we're kind of in this area where you just have a lot of shares that have transacted here. So the market is trying to digest supply at this point. One thing I would note, if we are kind of going into a recession or economic slowdown is maybe underway, copper is generally a function of that, right? So if the market's booming and the economy is really doing well, copper is generally doing well. There's more demand for building things, all that type of thing. If the recession comes in and we get economic slowdown, copper is likely not going to continue to move up unless we just have some crazy divergence between theoretically what should happen versus what is happening. Commodities are generally the last thing to top out in an economic cycle, right? So you've got bonds, then you've got stocks, and then you've got commodities kind of being the last one that goes. So if that's the case, I wouldn't necessarily look at copper as something that is going to do well if we do have a recession underway.
Yeah, well, that's the question. If we do a recession underway, what will do well?
Yep, exactly. And one that I've kind of kept an eye on. This is like pretty boring stock probably for most people, but Dow is an interesting one right now. So
not the actual Dow Industrial Average. You're talking about the chemical company?
Yeah, so Dow Inc. You can see here that we've got this pretty defined ascending triangle here. You've got a lot of different times where we've bounced off of this support zone, and so we're right back at it again here. So this is definitely an area, potential doji forming at this support zone. So if this does kind of move to the upside and breaks out of this ascending triangle, then you could maybe see a retest of these highs. So that's one to definitely keep an eye on. I know it's not the sexiest name out there, but it is one that actually has a decent setup here, and one that's been kind of on my radar as well. And then I know the previous guest mentioned Cbx Chevron. You've pretty much got this almost same exact setup that we just looked at on Dow that's actually started to break out. So you've got many times where we tested this previous support zone, you broke out, now you're retesting this previous resistance, now acting as support over the last 5 trading days or so. And so, if we do continue up, then I would, you'd have to zoom out here and look at the all-time highs, and we're way above them, right? So there's nothing to the left. So what you have to do is, you essentially have to use the measured move and use fib levels. So the measured move that I personally would use for a target above would be this area here to this area here. And so I'll add, I don't like to use the 0 and 1 like on the chart. It just adds noise to me personally, but this is the measured move here. So we're measuring from this point here from March of 2022, connecting it here to this low in April. And so the 1.618 extension is right around 190 here on Cbx, which is Chevron. So that'd also be a level to watch above on Chevron. Oil is doing really well right now, but we also were talking, a year and a half ago or a year ago, how well SQ was doing, how well these growth names were doing. So there is a point where you do have to start realizing trends do not last forever. And so until this 200-day simple moving average starts to kind of flatten out, and the 50-day starts to kind of slope down again, this is still in a pretty strong uptrend. Now, if you wanted to go and maybe use the SMA 20 as a little faster of a moving average, we're actually just breaking above the 200 and the 50 over the last week or so. So this is still in a pretty strong trend to the upside for now, but will it last? We'll have to see. I just don't necessarily see the economy doing incredibly well if we're seeing prices rise like they are in the gas side of things. For the average person who maybe fills up once a week, I remember we'd fill up our SUV. It was 55, maybe 60. Now it's like 82. $22 is not going to do anything, unless you just have a very tight budget, and $22 is going to get you out of the budget. It's not about that. It's more about these transportation companies that use so much oil and gas to fuel transportation. That's what drives up prices that are actually going to make a dent in these budgets that people have on weekly or monthly side of things.
Yeah, and I mean, I think we talk about the trend being your friend a lot. Like, obviously, the strength is here in these oil and gas companies. I don't, as long as gas is $5 a gallon, it's hard to imagine that these companies aren't just going to be printing money, and then of course they pay good dividends as well. But I mean, eventually, Jake, we have to talk about them getting overextended, right? If they go up another 20% from here, I mean, it's like Chevron alone is up 30% over the last 3 months. I mean, maybe not. I don't know.
Well, I mean, this is where having a general, idea of how far extended above the moving average it is, right? So back in 2021, we were extended about 30% above the 200. Right now, we're right about that, maybe a little higher. We're about 32% above the 200-day moving average. So that has generally been, an area where we get a reversal. Same thing here. I mean, look at here. Above the 200, you were about 20%. Very strong correction back down, kind of a mean reversion type of move. And that works on the opposite side too, right? Back in 2015, you were down from the SMA 200, you were down like 32% below it. What happened? We mean reverted back to the 200. So it seems to me, just based on a quick glance, I haven't actually done analysis. This was my analysis on it, live. We are at a point where we're very overextended in relative, in relation to the SMA 200. And so, if history is any type of guide, this has been a top when we've been extended that far from the 200-day.
All right, so I think that'll be one to watch out for. I've made some money, trading some puts on Chevron and throughout this big bull run when I feel like it's been overextended. But I'm kind of sitting on my hands right now waiting, because it's just like, I mean, geez, in this market too, it's like I feel like whatever is strong is going to continue being more strong as people just try to flock to whatever is showing strength.
Yeah, I mean, look at this 200-week moving average. I mean, we are just in a different level at this point as far as being overextended. I mean, even if you look at 2007, 2008, when oil was about as high as it is now, you were about 52% above the 200-day moving average in 2008 when we reversed. Right now, we are 60% extended above the 200-day. So this is definitely one of those things where I personally am going to be contrarian, and I'm going to say that we're probably close to a top in oil and oil companies.
I love it. I hope so.
I'm happy to be wrong, but this is not sustainable.
No. You're not happy to be wrong, because if you're wrong, that means oil's going to keep going up and gas prices are going to keep going up.
Yeah.
Which
right.
JP Morgan did call for I think 630 gallon gas by the end of the summer, and we're freaking getting close to there. It seems like I do. We do have to run, Jake, but I have been talking a lot about the airlines, and like a lot of the talk around the airlines has been, oh, they've got increased costs with the increased jet fuel price. But if you look at flight tickets right now, it's hard not to imagine that the airline companies aren't effectively passing those raised costs off to customers. I mean, I know we've talked about flights, Jake, you and I, over the past month or so. I mean, even when we were in Vegas, like flights were just insane.
Yep. Kind of crazy.
Right.
But we'll see where we're at next week and reevaluate.
All right, sounds good, Jake. Always a pleasure to get you on. Jake Wujastyk from TrendSpider. I'll go ahead and drop the link to TrendSpider in the chat. You can use the code BZ25 for 25% off. Jake, always a pleasure to have you on.
Thank you. We'll see you next week.
All right, y'all. We are going to keep the show clipping. I got Sean Cruz hanging out backstage from TD Ameritrade. Schwab, we're going to be talking to Sean about what he's been looking at. But before we get to Sean, I was talking about a little bit of sports investing in the chat with my man 30. I'm just going to go ahead and read this parlay out loud that I'm rocking with tonight. $25 to win 866, 5-pick parlay. So this is, think about this as like a way out of the money call option that expires tomorrow, right? Chances of hitting very low, but high payout, high risk, high reward if it does. We've got Arizona Diamondbacks -1.5 against the Reds. I believe Bumgarner's going for the Diamondbacks. I don't even care who's pitching for the Reds. They are not good. They've been playing better. The Reds have been, but still not great. Houston money line against Seattle. Houston's playing at home. I like that. Los Angeles Angels -1.5 against the Red Sox. I forget who's pitching for the Angels, but I know Michael Wacha's pitching for the Red Sox, who I used to love. He used to be on my team, the Cardinals. He's not that great anymore. And for that reason, I'm also taking over 9 in that game. You know, the Angels have kind of that high octane lineup with Ohtani and Trout. So I'm taking over 9 in the Boston Red Sox Angels game. And then we've got Padres money line against the Mets. The Mets have been amazing, but the Padres are a solid team as well. I forget who's on the mound for either of those teams, but honestly, that'll probably be the biggest question mark. Padres, Mets. I had an interesting day sports investing yesterday. I can talk more about that maybe after our next guest. But let's go ahead. Madison Bum, he's a pitcher. He's not a bum though. Well, I don't know. He went from being like Cy Young to now he's not so much anymore. But that happens. People get older. All right. Enough about sports. Let's go ahead, bring Sean Cruz on. Like I said, we might get a little touch on sports again after Sean, but let's go ahead and bring him on. Mr. Cruz, how you doing today?
I'm good. How about you?
Pretty good.
I was trying to get those picks jotted down real quick when you were rattling them off there. So
hey, well,
I might get
lucky.
Too.
Lucky for you, I put it in the chat. For some reason, I had it all in the chat in like different lines, so it looked all pretty. And then when I entered it, it went like this, so it doesn't look good. Here, I'll do it again. But so do you get into some sports investing as well?
I do every now and then. I'm not. There's people out there who have commas on their wagers they're putting out there, but I'm usually more just to make a game I otherwise wouldn't care about a little bit more interesting.
Yeah, and that's where I'm at too. Like I'll have like things like this where it's like, yeah, I'll throw $25 on this parlay. If it hits, great. If not, oh well, I spent $25 and I probably got $25 worth of entertainment out of it.
And maybe you get like 3 games in before the parlay busts. All right, you know what? I've been very involved in 3 games I probably wouldn't even otherwise taken a look at. But yeah, no, interesting. See what happens. Baseball, you never know.
You never know. Introduction, kind of what your job is, what you do.
Yep. So I'm the head of trading strategy for TD Ameritrade. We're going through the merger with Charles Schwab. So that's also, another piece of what I'm doing is getting a lot of things done on the integration front. But, lately the job's been very exciting because it seems like the ebb and flow of the market, has been changing almost day to day. And if you think about it, for a lot of people, myself included, when I started, in 2010, the VIX in the market just kind of, the VIX was at 14 or 13 and the market just kind of trended higher almost nonstop, maybe a couple blips on the radar there. But,
that's boring though.
Yeah, the volatility we've been seeing the past couple of years, it's definitely something that's going to keep you engaged in the markets. But for traders, and especially short-term traders, it actually creates a lot of opportunity to get into and out of some of these trades. And this is a lot of the headline-driven stuff that we're dealing with right now, and I expect it to continue. Think of Beijing opening up over the weekend. Everyone is attributing the rally to that. That's exciting, but they've sort of recommitted themselves or reiterated, hey, we are sticking to zero COVID. So just as fast as they can lift those restrictions in Beijing, the market rallies, you could get another flare up in Shanghai, some other city, and they're going to put them right back in place. That's what I mean, where there's just a lot of headline driven volatility right now that's going to keep you engaged in this market.
Yeah, and that's why it's like when you're talking to people just about the volatility in the market, right? If you're like a buy and hold investor, maybe someone who's just investing for their retirement, it's like, oh my God, the market was down 8% last week. Like, I can't believe it. But for people like you're saying that are more quick in and out, kind of trading that volatility, it's like, oh, this is a great trading environment. Well, maybe not great just because it's so unpredictable, but at least exciting.
You get the moves, and that's really when you're trading, usually you do want volatility where maybe you see it. And when you get the kind of volatility that we've been getting lately, moves get overdone on the upside and the downside. So I know your last guest, I assume he's just on every week right before me. I'm getting used to seeing him on there when I'm in the waiting room there. But he always talks about some of these technical levels and where you're seeing things going. And that is actually one interesting thing is when these moves get stretched, and get a little bit overdone on the up or downside, that is where a lot of market technicians will go in there and start seeing some of those opportunities to get into or even to get out of a specific trade. And on the options front, elevated premiums, the VIX being elevated is an indicator that premiums are higher across the board. That also is where you see a lot of options traders coming out there and taking advantage of that using premium selling strategies. So I know VIX is down 25, which is funny because it seems low relative to where we've been. We were stuck at 30, it seemed like, for days and weeks on end. But the VIX at 25, there's still a lot of premium out there. I think that means a lot of the genuine concern and fear is coming out of the market. And I think it makes sense because we're also out of, a lot of the big earnings reports. A lot of those are behind us. We've got a few this week you can keep an eye on. But I think it's generally saying that the uncertainty and the fear is abating a little bit, but we're still not in the clear yet.
Yeah, and I know for a while when that VIX was elevated above 30, there were a lot of traders and people out there basically being like, oh, look for when the VIX drops below 30. That'll be a big bullish sign, where it's like a lot of times the VIX is kind of lagging, where it's going to move based on what the market's doing and not the other way around, in my opinion, at least. Sean, do you have insights into just as far as like retail, what retail's been doing on, through TD Ameritrade, through Schwab?
Yeah, so the one thing we put out our investor movement index today, and there was something really interesting this month. And we track the score overall tells us if they're, how defensive, are they getting a little bit more aggressive out there. When you see the IMX index itself rising, that means there's a lot more risk seeking appetite. When it's falling, that doesn't necessarily mean they're running for the hills, but it means they're buying more stable, less volatile types of names. So this month, we've seen it actually in months past where it was falling, but clients were still net buyers of equities overall, but they were just buying the little bit more less volatile, more defensive type of names. This month, we actually saw for the first time since December, they were net sellers by a pretty significant margin. And to me, that is, if you think about everything we were getting, the Fed rate hikes were starting to get priced in there for 50 bips, multiple 50 basis point rate hikes. Earnings it didn't matter which company, which sector, which industry. There was not much you could take in terms of positivity away from what management was guiding for the rest of the year. And you have that with, the escalation of lockdowns in China. You have the sense that the Ukraine-Russia war is not going to resolve itself anytime soon. I think it makes sense. You have a lot of investors going to the sidelines, and we also had the 10-year yield up above 3%, and so we actually saw some net buying in treasuries, which is, to me, that is the
retail buying treasuries.
Yeah, I know it's not something we typically see, but I think it makes sense. We've also, we haven't had treasuries, the 10-year up at 3%. The shorter part of the curve was also pretty elevated right now. So we just saw a lot of net treasury buying going on over the time period, which I think that's more of the longer term investor. I don't know that that's necessarily our traders that are our trading client or active trading client population. That to me is probably more long-term money positioning.
Yeah. I just find it so interesting. Throughout the if you think about from like January when we were at market highs to April when we officially went into a bear market, at least on the NASDAQ. I think the S&P 500 was hanging out right around 20%. I think we briefly crossed it. I don't think it's there right now, but that whole time, I was seeing headline after headline, whether it was from Goldman, whoever, just basically saying like retail is still buying. And actually, I was talking to a financial advisor at one of the big banks, and he said, I'm going to, start buying again when I see that retail has stopped buying. Basically, that when they become net sellers, that's when I want to get back in. Do you know why why he would say that, why that would make sense?
Yeah, I can't really speak to the motivations for what everyone else out there seeing, but I think when you look at the market, where is that? And for us, it's not always just they're buying, they're selling. We look at individual names too, as far as where that demand is. And there was some net buying that was going on, but it was in more like those core established companies, the companies that are cash flow positive, that aren't expected are they going to flip to being a cash burning type of a company?
Your Apples.
So, yeah, Apple, Amazon, some of the bigger chip makers. They were actually going in and buying those companies when they were just getting completely beat down over the month. What they're really shying away from is companies where we think we're going to be cash flow positive or earnings per share positive maybe in 2 or 3 years, but that's a little bit uncertain. Those are the companies that they're shying away from. So I think when you say, retail's buying or selling, I think they're going away from some of the frothier, more uncertain type of an outlook companies. And getting towards more of a quality, solid fundamentals, solid earnings and growth prospects moving forward. And with some of the pullbacks we saw, the valuations became a little bit more attractive over that time period too, where they were rotating out of some areas that were still holding strong. Energy did fairly well. They were actually selling that and using that money to rotate into Amazon, Apple, Microsoft is another one, just the very popular names.
Yeah, no, I think that's, and it's just we've gotten to that point in the market now where really the entire market is kind of driven by those core 5 names where it's, if Apple's up, S&P 500 is up and vice versa. Are there any other things kind of top of mind that you've been seeing the past couple of weeks that you found very interesting?
In the options front, and I may have discussed this with on your show with Spencer before, but we've seen a continuation of this trend at the industry level overall, where single name options, their volumes are actually falling off a little bit. But ETF and index options, those are actually those are continuing to increase year over year, month over month. I think that shows that the macro themes are probably where a lot of traders are gravitating towards, just in terms of putting whatever their opinion is on what's going on any given day. They're still going into the more macro type themes. That's what they're comfortable trading against. I was surprised to see that in a month where you have some of these big tech names out there reporting earnings. That's usually when you see a lot of options trading volume around those earnings events. I thought that would maybe drive a lot more activity at the industry level in the single names, and it actually didn't. It still remained focused on ETF options and also on the index option front.
Yeah, and I do know I just saw this on Twitter over the weekend that the option expirations for June, so it would be the third Friday in June. Let me get the date real quick. So the 17th is like one of the biggest OPEX, at least right now, like set to be one of the biggest OPEXs ever, where I think they said like the total amount of money, I can't remember the actual dollar amount right now off the top of my head, but it was over 6%. The value of the option contracts expiring on the 17th, it equates for more than 6% of the total U.S. equities market, which just seems insane to believe. So I don't know if you follow the options expirations at all.
Yeah, we do. And you know what? We've actually said that frequently over the past couple of months, where this is the biggest. January was another one where it was massive, absolutely incredible how much was rolling off at that January expiration. And then we actually had another one in March, was another pretty big one as well. So I think it just shows that there are a lot of built up open positions out there. But there's some deleveraging going on. And I would attribute where that we're seeing that deleveraging show up in a lot of the FINRA data, just in terms of overall margin debit balances out there. I would attribute that to some of these positions rolling off and not getting reestablished. You know, on the other side of that, very often you'd have a big expiration, but if I'm holding a large options position, I either close it out or I let it expire, but I reestablish another one, say 3 months out, 6 months out, whatever my time horizon is. Just keep rolling that over and over to keep maintain that position. I think with the deleveraging we're seeing across the board here, you're probably seeing people let those positions roll off, and they're not necessarily reestablishing those positions right away. So I think if you want an interesting leading indicator, or just a sign that there is a lot more, say, enthusiasm or people are more comfortable coming back in the market, if you watch that FINRA margin debit report, that would probably be something interesting to keep an eye on. If you see that number turn around and start climbing higher, that to me would be an indicator that there's a little bit more of a risk-seeking type of behavior coming back into the market.
Yeah, well, Sean, I'm sure your role right now is just crazy with the way the markets have been. Do you foresee anything, happening, any big like news stories that may kind of alleviate some of the volatility in the markets?
I wish I could be optimistic for you and say I do, but I mean, I just really don't. You have one where China, like I said, they're committed to zero COVID policies. If you think you've seen the last flare up of COVID in China, you're probably setting yourself up for some disappointment. So there will be, I would assume, unless China abandons their zero COVID policy, you're going to probably get another round of lockdowns at some point this year. And then the other one is the war with Russia and Ukraine. I don't see that getting resolved anytime soon. This seems like it's settling in to be just more of a long, drawn out kind of slugfest back and forth. And I don't see any side being able to come to an agreement. So they seem pretty cut and dry on where they're at. They seem miles apart on what they want for to stop the hostilities. So with those two things out there, and I just don't see them getting resolved anytime soon, I think it's going to continue to drive volatility. And then sort of the wild card on the side will be what happens with the Fed. When the Fed actually hasn't started quantitative tightening just yet. They're supposed to start letting the balance sheet roll off here in a couple weeks. So we still don't know what the effect of the Fed letting the balance sheet roll off, how that's going to affect market liquidity. And that could be another sort of gas on the fire just in terms of driving some more of the volatile swings we've been seeing out of these markets. Got it.
Yeah, I mean, as far as just the different, macro headlines throughout the world, whether you're talking about Russia, Ukraine, China, I think there was, and I've said this on the show before, there was a point like 2 or 3 weeks ago where quite literally every single thing you could look at was like as bearish as it could be, right? China was fully locked down. The war in Russia and Ukraine was, no end in sight, and still no end in sight. The, inflation running hot, consumer demand drop, basically just everything where I was like, literally there can't be a headline that would make things worse right now, right? Like China, like you have to think from where we were at least a month ago in China, like things 6 months from now would have to be better because they can't really be worse. Like people couldn't leave their apartments or condos for months on end. Like, so, I do hope, obviously, we do see some sort of kind of bullish headlines coming out of some of those issues, but I hear you. You got to be cautiously optimistic because you can't think.
The one thing I would say, maybe I want to be optimistic, keep an eye on some of the inflation data that's coming out. So we get consumer credit tomorrow. I keep an eye on that. That's going to be interesting to see just how the consumers continue to handle this environment. But the other thing is, on Friday, we not only get CPI, but we also get the Michigan Consumer Sentiment Report, which actually has some expectations from consumers on what they think inflation is going to do. And economists use it's a really important.
But what's been interesting about the consumer sentiment is throughout the last year or so, whenever we first started talking about inflation, consumer sentiment has been dropping. People have been saying they don't feel as confident in the economy, but the spending has actually gone up. So it's like people are saying they don't feel good about the economy, but still spending money. So there's kind of a, there's kind of like a disconnect there, it seems like.
There is, and that's why I think the credit report. So I think what they're doing is they're maintaining some of that consumption, and they may be using credit to do it, which could introduce its own separate spate of problems for us. But I do think it's interesting that they were really starting to indicate concerns around inflation in particular, which comes out with that report. They were starting to say that was becoming more and more of a concern. Before things really started showing up as driving turbulence in the market, which they are now. But any sort of sign this Friday that inflation is maybe at least peaking out, or at least not going to be climbing higher and higher, that might be one solid development for the market, just because elevated inflation is just by its nature historically always very volatile and hard to predict, and it makes a lot of business decisions, business planning, also then difficult to do, and it can actually hold back investment in an economy. But I think looking at Friday, what we see in not only the CPI number that comes out, but also the consumer sentiment numbers, I think that's going to be important. So if I'm looking for one potential bright spot this week, it'd probably be Friday, but it also could be a big driver of volatility because there's just not too much else on the radar this week outside of consumer credit and some earnings.
Yeah, and I'd be shocked if CPI doesn't come in lower than the previous month, and then if that happens, that'd be 2 months in a row where we've gotten lower inflation month over month on the CPI front. So. Which could be seen as kind of an indication that it could potentially be a top in inflation, which I obviously hope so. I mean, you have a few, I think travel expenses like flights I was talking about earlier, and gas prices will probably be like the two things higher, and then pretty much everything else I'm expecting to be lower in the CPI. But we'll see. I completely 100% agree with you that like that throughout all the other shit going on, the one solace we can kind of look to is like, okay, maybe at least right now inflation is starting to drop.
That's it. Moderation. We don't even need a complete go off a cliff. Just I think moderation. The market would probably welcome just some signs of that, because we don't totally have a sense where we're topping out at just yet. And if you look at what inflation expectations are from economists and where their estimates are for this week, they're kind of all over the place. Historically, when it was low and stable, there was like maybe one person who was out there throwing some outlier prediction. But by and large, the core of economist estimates were always anchored right around the same spot. They're all over the place for this report coming up. So I think it is going to be interesting to see how the market digests a lot of that data when it comes out.
Yeah, and like I said, I mean, or like you said, like it doesn't need to be, I forget what it was last month, 8.3 or something. It doesn't need to go from 8.3 to 4. But if it goes from 8.3 to 8, and then that's 2 months in a row where we're dropping, then it's like, okay, like, hey guys, inflation's not rising still. At least it's still elevated, still higher than anyone is comfortable with, but at least it's not going up. So what'd you say?
It's not getting worse.
Exactly. Sean Cruz, always a pleasure to get you on the show. We'll get you on again next week. Are we doing it every week or every other week?
Yeah, every week.
Every week. Beautiful. All right, next Monday we'll get you back on.
Right, everyone.
All right, guys, that is Sean Cruz, the head of trading strategy at TD Ameritrade. Always some good thoughts there. That will go ahead and wrap it up for us today. We do have, it's kind of sentimental, sad first show without Spencer, but we'll make do. We do have Moon or Bust coming up. They'll be talking about the recent move in Bitcoin above 30,000, kind of what that means for crypto, what that means for the overall blockchain DeFi space. So definitely stay tuned for Moon or Bust. I'm going to go ahead, wrap up the show, and leave it to them.